Donald Trump has said he wants to make housing affordable again.
The Trump campaign recognized very much that we need to bolster supply in order to help improve affordability in the housing market.
In fact, he's actually signed executive orders trying to get home prices to come down.
Day one, he put over 100 executive orders, and one of them was focused solely on housing.
But will this pop the current real estate bubble, a bubble that's even bigger than what we had in 2006? And could that possibly also trigger a recession? I'm going to do my best to answer these questions for you in 3 simple, fast steps. Step number 1, let's go over this new housing indicator. Nobody's talking about this. In fact, you're only going to find it right here on the George Gammon channel. And I am calling this not the Buffett indicator, but the G indicator for George Gammon indicator. That's right. And the Buffett indicator, as you know, is the market cap of the stock market relative to GDP. So it's expressed as a percentage. So as an example, going back to the 1980s, the market cap for the stock market was about 30% of GDP. My memory serves me right. Editor, you can fact check me with the chart. But now it's right around 200%, indicating that the stock market is wildly overpriced and most likely in a big bubble. So I wanted to do the exact same thing with the housing market. Why not? So here we have the total value, or the market cap, if you will, of the United States housing market, residential. We go back to January of 2000, all the way to December of 2024. On the left, we go from 0 up to $50 trillion. So if we go back to 2000, a time when we were not in a housing bubble, we see that the GDP of the United States was 10 trillion. That's what this number is right here. And the market cap of the housing market was also 10 trillion. Okay, so that means our G indicator would be 100%. Here's the math right there to prove it. If I'm doing the math right, I'm probably doing it wrong. But then we go over to the bubble. You guys know prior to the GFC, 2006, that's when home prices were at that peak before we started to see the crash to where they bottomed out in 2012. But at this time, the GDP of the United States, right around 14 trillion, but the market cap of housing was, call it 23 trillion, right here. So that gives us a G indicator of 164%. Then we go to the bottom, the lows in 2012, and there we're around 112%, around 16 trillion for GDP and 18 trillion for the total value of the housing market. But you guys know what happens next. We move on to where the chart goes completely parabolic. And I always say, if we were in a bubble right here in 2006, where home values were right around 23 trillion, what on earth are we in right now when home values are right around 50 trillion? Cincuenta for all my Spanish. I'm working on my Spanish, as you can see. But $50 trillion, the housing market cap. So now we've gone from 164% in 2006, when we were in the last housing bubble, to what we are today, 166%. And that would be $50 trillion housing market cap versus a $30 trillion GDP. So the reason I'm going over this first is to show you the problem we have. And I think it's admirable that Donald Trump wants to bring down home prices. They're obviously way, way, way too high when you look at any metric, not just the G indicator, but all the usual suspects, such as home prices adjusted for inflation, and my favorite, the price to income ratio. Because at the end of the day, believe it or not, we use our incomes to make that mortgage payment. So you've got a couple very important variables, interest rates and incomes. So if you see the prices really exceed the income levels at a certain degree, that dog don't hunt. It is unsustainable, as they say about the United States debt. But I want to focus on the key here, and that's the 166%, which gives us an indicator as to how overvalued the market is, or maybe even more importantly, how dependent the United States economy is on home prices being at these nosebleed levels. In other words, the United States economy is completely dependent on a housing bubble that Donald Trump wants to pop.
Step number 2. So we know what the problem is, but what is Trump's solution? Let's go right over to navigatehousing.com, where they summarize the intentions of his executive orders to bring home prices down. Now you'll notice I said to bring home prices down. I didn't necessarily say to make housing more affordable. That is a crucial distinction. More on that in just a moment. So first and foremost, reducing regulatory burdens. The memorandum directs federal agencies to identify and eliminate regulations that unnecessarily increase the cost of housing construction. The administration aims to lower construction costs by streamlining these regulations, making homes more, not more affordable, bringing down home prices. That's the key. Expanding home supply. So obviously, if we have fewer regulations, you're going to have more supply and at a much lower cost. But the details here. Part of this housing affordability reform addresses the shortage of available housing. The memorandum emphasizes the need to increase the housing supply. This may involve incentivizing the development of new housing projects, encouraging innovative construction methods to expedite building process. And then number 3 here, we've got promoting efficient land use. Pretty self-explanatory. I know he has talked about using some of the land that the government owns for the development of new housing projects, and then encouraging the private sector participation. Obviously, we have to have the private sector if we want to make this sustainable and if we want to have a solution where the benefits are going to outweigh the costs. That's for sure. Can you imagine if DMV was in charge of all the new housing development in the United States? That wouldn't be too good. But what I want to focus on is the difference between how the government has made housing affordable in the past compared to what Trump is trying to do now. So in the past, we didn't really try to bring down home prices. All the government did is try to create financial tools or make homes more affordable through financial engineering. So they wanted home prices to continue to go up, but they wanted the down payment or the monthly payments to remain the same. So you basically get all these government subsidies and you have all these programs that are basically creating economic distortions. One of them, the elephant in the room, is Fannie and Freddie and the 30-year fixed rate mortgage. My point there is we've never taken this free market approach where we're actually trying to make housing more affordable by bringing down the prices. What we've done in the past is we've just tried to create these programs in order to make the higher prices more affordable in terms of a monthly payment and a down payment. And why is this important? Because in approach number 1, the free market approach that Donald Trump is taking, prices actually will come down. Whereas the latter approach that we've been doing pretty much since the late 1990s, prices will continue to go up. And I think everyone is in favor of housing being more affordable, just so long as the price of their home doesn't go down, which takes us right back to step number 1. And what we were talking about is how the United States economy is dependent on these home prices being at these astronomical levels. So what happens when Donald Trump, and I definitely approve of this approach, tries to eliminate regulation, increase supply to bring those home prices back down to a normal level.
Step number 3. Now let's go ahead and connect some dots so we can come to some conclusions as to what the probabilities are that if Donald Trump implements this plan, we see a crash in the housing market and possibly a recession. So we're going to go back to the good old G indicator that we used in step number 1. And actually, before we do, I want to highlight this number right here. Because at the end of step number 2, remember, we were talking about Trump reducing all of these regulations. And I'm sure a lot of people were thinking to themselves, okay, well, how much could that possibly reduce the price of a house? I mean, let's say the average home price right now is $400,000. So what, George? Maybe it takes off $5,000. At the end of the day, that's not really going to move the needle. But check this out. Regulations add approximately 23.8% to the cost of single-family residential real estate. And if you think this is a shocking number, I would challenge you to sit down, pour yourself that stiff drink, and look at multifamily, clocking in at 40.6% of the cost to build a new apartment complex is regulations. But it doesn't end there with what Trump might do to reduce bureaucracy. Editor, go ahead and cut to a clip from a recent episode of Monetary Matters, hosted by Jack Farley, and he had a guest named Chris Whalen, who is an expert in the mortgage industry and the banking industry, talking about what he thinks the Trump administration, Doge, and Elon Musk might do with Fannie and Freddie.
What I'm saying is they're going to go after the entire apparatus of government that has grown to support the private sector. So housing. Housing is the most subsidized part of the U.S. economy. In most nations around the world, if you buy a house, you pay cash. They don't have credit for housing. The U.S. has used credit to boost housing, used that to boost growth. Really, since World War II, we went from the military-industrial complex to the housing complex. That includes the realtors and the home builders and everything else. If you look around the country today, Jack, what do you see? You see a lot of spec homes above the average price, well above $500,000 that aren't selling. We built too many of them. So we do, use credit to goose housing. And Trump is dismantling this. In fact, this morning, when I got in front of my computer, I found out that a number of my friends at the regulator for Fannie Mae and Freddie Mac were laid off last night. And you're going to see headcount reductions at Fannie Mae and Freddie Mac probably this week.
So let's get back to the G indicator and assume for a moment that Trump is able to reduce home prices by 25% by allowing the free market to actually work. So just a rough number there for the sake of the example, but I think it's actually realistic. Now, he's not going to eliminate all the regulation, but let's assume he eliminates 50%, and you combine that with reducing the government subsidies through Fannie and Freddie and all these other programs. And like I said, I think that 25% number is actually realistic. But let's remember that home prices are priced at the margin. What I mean by that is the value of your home is really predicated upon what the home right across the street sold for. It's all about the comps at the end of the day. So if we have new housing supply coming onto the market that is 25% lower than the existing housing supply, that's going to impact the comps, bringing down all home prices, including the price of your house, whether we like it or not. So how much, let's say, market cap will that reduce from the overall value of the housing market? Because we have to figure this out, because that's crucial for the purchasing power of the American economy. Okay, well, if we cut this number by 25%, start off at $50 trillion. That takes us down to 37.5 trillion. Now you say, George, that's never going to happen. That's just a number that's unimaginable. Well, it's actually not that extreme when you think that the ratio would just be at 125%. Remember, 2012, we're 112%, and in 2000, we were at 100%. You see, that's the problem with driving these home prices to nosebleed levels, is at some point it's completely unsustainable. So this is a lot of fun, but this is where the rubber meets the road, and you've got to take some of that economic pain to bring things down to a more normal, sustainable, and fundamentally sound level. So let's put some specific numbers to it here. What this would do is reduce the household net worth in the United States by $12.5 trillion. And again, that doesn't even get us down to a level, as far as the prices, that are consistent with where we were in 2012 and 2000 in terms of GDP. And if we're getting down to these levels in terms of GDP, we're also getting down to more fundamentally sound levels in terms of price to income ratios. The problem is you've got to take some very difficult medicine in order to get the housing market and the US economy back onto sound footing. And to illustrate this, I always like to use the visual of the economy being this inverted pyramid that's sitting on top of assets, in this case, housing. So if you were to take that house down in price, then the whole economy topples over, just like a Jenga puzzle. But what we should be shooting for is something, let me get my black pen here, that actually is the opposite. So we've got the house or the asset on top, and then this is the economy on very solid ground. Therefore, the asset prices, the S&P 500 included, and the housing market would be on very solid ground as well. So will Donald Trump be able to make housing affordable again the right way by bringing down home prices, possibly creating a housing crash where the values of homes go down 25% or more? The answer is, I hope so. Because although this would cause some extreme problems in the short run, potentially even triggering a recession, over the long run, society would be much, much better off.
Hey guys, I wanted to take a quick break from the video to share with you a new investment strategy I've been using. Most of you know the cornerstone for my portfolio is physical gold. The problem is you always have a negative carry because you have storage fees. Same thing with silver. But I've actually found a way that you can be paid to own physical gold and silver. And here's the best part. You're not just paid an interest rate in fiat currency, you're paid an interest rate in more precious metals. Now, I know a lot of you are saying, oh, George, this sounds too good to be true. And it's exactly what I thought when I first heard about this. Here's the backstory. I get a lot of businesses that come to me and say, George, we want to sponsor your videos. Usually I turn them down because it's not really a good fit. But I had a company come to me the other day called Monetary Metals. And when they were walking me through what they do in their business model, I thought to myself, this is a complete no-brainer. In fact, it sounded so good, I set up an account myself, and it's been going extremely well. So I said, sure, sponsor a couple videos, because this is a service that I think would be hugely beneficial to my audience. So here's how it works. You can go ahead and set up an account with them and fund it with your existing precious metals, or you can buy directly from them, usually a little less than 1% over spot. And right now, as we speak on the platform, there's opportunities to be paid about 4% interest. So again, this is not in fiat currency. They're paying you in additional precious metals. So if you deposit, let's say 100 ounces of gold with them, at the end of the year, you'll have 104 ounces of gold. So to join the thousands of investors, including yours truly, who are being paid to own physical gold and silver, you can go to monetary-metals.com/gammon. That's monetary-metals.com/gammon.